Welcome to the Explainer. Have you ever placed a trade, watched your stop loss get perfectly triggered by a fraction of a cent, and then immediately watched the market reverse exactly where you predicted it would go in the first place? It's literally maddening, right? Well, you aren't cursed, and honestly, it isn't bad luck. Today, we're exploring the brutal reality of day trading traps, and we're going to bridge that micro-level market manipulation with a massive, real-time 2026 macro case study on Polkadot. We're going to see exactly how retail traders get absolutely slaughtered by the noise, while institutions quietly scoop up the fundamental reality. Okay, so let's dive right into this. Why do 97% of day traders fail? 97%. That is a massive, honestly intimidating number. Get this. This specific figure originally comes from a really rigorous academic study of the Brazilian equity futures market, watching traders over a 300-day period. But the math directly applies to digital assets for sure. Data from the Bank for International Settlements tracking retail crypto apps across 95 countries confirms this exact same pattern. The vast majority of retail users sustain net losses, just constantly getting picked apart by a market they completely misunderstand. To truly understand the sheer violent scale of this failure, we have to look at the terrifying liquidation cascade that hit the market between November 20th and 21st, 2025. In a single, brutal 24-hour window, over-leveraged retail accounts had $1.7 billion completely wiped out, gone. Roughly 396,000 individual trader accounts were forced closed. And why did this happen? Well, because they misjudged market volatility and used excessive leverage in an environment where even routine price swings can literally trigger total account destruction. But it's not just the leverage doing the damage. It's us. Behind those liquidations are four psychological traps that systematically erode trading equity. First, overconfidence bias, which leads to massively oversized positions. Then there's the disposition effects. That's really just a fancy academic term for holding on to losing bags way too long because our egos absolutely hate admitting we were wrong, all while we cut our winning positions way too early. Then you have herd behavior, right? FOMOing in at the absolute top. And finally, revenge trading, that furious, primal urge to impulsively double down after a painful loss just to get back to break even. These cognitive biases will completely override any technical edge you think you have. Now, compounding those psychological flaws is the hidden structural reality of the market. And here's where it gets really dark. Institutions actually weaponize our obvious retail psychology through something called a liquidity sweep. Think about it like this. Large institutions can't just buy tens of millions of dollars of an asset at once. There just isn't enough resting liquidity without causing massive price slippage. So their algorithms deliberately push the price just below a universally known support level. This intentionally triggers a massive cluster of retail stop losses, generating the exact sell-side liquidity the institution needs to fill their giant buy order. Once filled, the price immediately reverses, leaving retail completely in the dust. Let's see how this builds. Because the reason retail falls for these sweeps really comes down to a severe information asymmetry. Think about what retail traders rely on: lagging indicators like the RSI or MACD, and basic candlestick patterns based on historical data. By definition, they are looking backward in time. Institutions, on the other hand, are looking at forward-looking, raw transactional data. They monitor things like perpetual funding rates to see if a breakout is driven by leveraged speculation or actual spot buying. And most importantly, they are looking at CVD, cumulative volume delta, or CVD. It tracks the real-time net difference between aggressive market buyers and sellers. It basically tells you the actual intent of the market. For instance, if you see the price of an asset rising, but the CVD is actively falling, that is a massive structural warning light blinking red. It means the price move is running on empty, and smart money is passively absorbing retail FOMO with limit sells, setting up a massive trap right before the floor falls out. Section 1, Polkadot, dead or alive. Zooming out from the micro traps to the macro reality. So to see how these micro traps blind us to macro reality, we're going to dive into our 2026 case study, Polkadot. And we just have to address the elephant in the room directly here. From its 2021 peak, Polkadot's native token, DOT, suffered a 90+% price decline, bleeding really heavily through the bear market. Because of this, retail traders who are stuck staring at that lagging price action we just talked about labeled it a quote-unquote dead chain. But if we look past the lagging charts and examine the actual network infrastructure and developer data, it tells a totally different story. And this brilliantly illustrates exactly what I mean. Based on 2026 data over a 30-day period, Polkadot is far from abandoned. It actually holds a top 6 global rank in core developers with 98 active contributors. Notice how it's actively outpacing highly hyped chains like Sui and Cardano. The developers never left. They've just been quietly, steadily building the next iteration of the network. However, we also have to deliver the uncomfortable truth firmly here. Despite this incredibly robust development base, Polkadot's on-chain metrics are undeniably weak. As of April 2026, its total value locked, or TVL, sits at roughly $40.5 million, compared to Binance Smart Chain's $4.1 billion or Cosmos's $2.8 billion. Polkadot lags massively. This really highlights a network that is in a painful, messy, mid-transition phase, completely overhauling its infrastructure from the ground up. Section 2. Fixing the inflation problem. The end of continuous dilution. Okay, so a major reason for Polkadot's lagging price action wasn't just a lack of TVL. It was the protocol's underlying economics. For years, Polkadot ran on a roughly 10% open-ended annual inflation model. That created this embedded headwind of continuous dilution for long-term holders. But if we track the timeline, there is massive institutional and technical momentum happening quietly to fix this, right while retail traders are distracted by short-term chart sweeps. They rolled out Agile Coretime to replace those clunky parachain auctions. A U.S. spot ETF launched. They passed a massive supply cap. And they are aggressively moving toward the JAM upgrade, which is a comprehensive mainnet transition meant to turn Polkadot into a decentralized supercomputer. Now, what's absolutely crucial about this transition is the passing of referendums 1710 and 1828 on March 14, 2026. This was arguably the most consequential tokenomic shift in the network's entire history. It placed a hard, absolute cap of 2.1 billion tokens on the network, permanently killing that open-ended inflation model. It cut annual issuance by over 50% on day one and introduced a burn mechanism directly tied to block space usage. Game changer. And alongside this cap, they completely reformed DOT staking. They moved rewards to a capped issuance pool, so your yield isn't just subsidized by silently diluting your own holdings. Crucially, they took a massive machete to that grueling 28-day unbonding period. Actually, let's call it what it was, a 28-day liquidity trap. They slashed it down to a highly liquid 24 to 48 hours. Think about how massive that is for capital efficiency. Plus, they granted nominators unslashable protection, removing the risk of losing funds just because a validator made a technical mistake. These steps completely overhauled the risk profile, making the network so much more attractive to big institutional capital. Section 3. Institutions versus the charts. How asymmetric information controls the market. This brings us right back to our core theme, the massive gap between retail panic and institutional mechanics. On April 13th, the headline screamed that an attacker exploited a bridge and minted 1 billion wrapped DOT tokens. Retail traders, reacting entirely to the headline, totally panicked and instantly sold off their native DOT holdings at the absolute bottom. But here is the reality. It was an isolated Ethereum side gateway issue, causing about $2.5 million in actual losses. Native DOT on the Polkadot network was completely secure and 100% unaffected. This is exactly how information asymmetry traps retail traders into panic selling on fake-out news. And who do you think was happily buying that dip while retail dumped their bags into panic? Yep, institutions. In fact, just weeks prior, the 21 shares T.dot ETF officially launched on the NASDAQ. For the very first time, structural institutional buyers, we're talking pension funds, registered investment advisors, finally got U.S. brokerage-level access to spot DOT. So while retail traded the noise, institutions were calmly stepping in as the capital channels opened up, right as the tokenomics became deflationary. So the crucial point here is that smart money isn't trading the lagging RSI, and they certainly aren't panic selling over fake-out headlines. By May 2026, derivatives data showed top traders aggressively building long positions, creating a rare 74% bullish consensus. The institutional players are positioning for a breakout because they understand the fundamentals have structurally shifted, even if the price chart hasn't quite caught up yet. To avoid falling into that retail trap yourself, you need to track the data that actually matters. Over the next few quarters, keep your eyes heavily focused on these concrete fundamentals. Watch the T.dot ETF assets under management to gauge true institutional appetite. Track the Agile Coretime sales volume. Are developers actually buying block space? Monitor the ecosystem TVL to ensure it stabilizes and actually recovers. And finally, make sure that Polkadot maintains its top-tier ranking in those 30-day developer counts.
Section 4, the fundamental takeaway, rising above the noise.
All right, the overarching lesson here is clear. Surviving and thriving in digital assets means actively stepping away from those cognitive biases and short-term traps we discussed at the very start. You have to stop playing a two-dimensional game against algorithms specifically designed to sweep your liquidity and start looking at the structural, macro reality of the networks you're studying, which leaves us with this final, vital question to ask yourself the next time you look at a giant red candle on your screen. Are you trading the emotional noise of the chart, or are you investing in the structural reality of the underlying network? It's time to upgrade your entire framework of analysis. Thanks for joining me on this explainer, and keep your focus on the fundamentals.